Hi, and welcome to Leavitt Brothers tutorial on bearish symmetrical triangles. Bearish symmetrical triangles represent neutral periods of doubt and indecision. They're characterized by a series of higher lows and lower highs as the forces of supply and demand are nearly equal. Each rally is seen as a selling opportunity while each dip is met with buying. The pattern is typically large and takes several months to form and should have a nice gentle shape. The trend line should not be too steep or too flat. Bearish symmetrical triangles really should be aesthetically pleasing to the eye. The best breakdowns occur 1/2 to 3/4 of the way through the pattern. A stock seems to gain energy as it's compressed into the triangle, but that energy dissipates beyond the 3/4 mark. It is recommended that traders abandon the setup if a stock trades beyond the 3/4 mark, for very little movement is likely to occur. But that does not mean the stock isn't still playable. It's just that the triangle is likely to morph into another type of pattern. Volume typically diminishes as the pattern develops because traders become more and more unsure as to the stock's future direction. And like other bearish setups, breakdowns do not have the same volume requirement as their upside counterparts. In fact, there often is a delayed volume surge. When a stock breaks support with a massive surge in volume, it can often signal that of a capitulation sell-off, and the stock often rebounds shortly after. The best downside breaks occur on average volume, followed by the stock drifting lower for several days on increasing volume. Psychologically, when a stock first breaks support, stockholders become concerned. Many of them show a loss and some sell. As the stock trades lower, concern becomes fear and the selling accelerates. Then fear becomes panic and people sell regardless of price. This is why there typically is a delayed volume surge with breaks to the downside. To confirm the break to the downside, the most recent low from within the pattern needs to be taken out. There are a couple methods used to determine the expected price movement. 1. The widest part of the triangle will dictate the price movement out of the pattern. 2. Price movement will equal the move into the pattern. Some traders will measure to the far side of the pattern as shown here and then project it down from the breakdown area, while other traders will measure from the midpoint as shown here. And 3. Price movement is likely to be contained by a trend line drawn through the low of the triangle and parallel to resistance. The extent of a decline will often depend on the overall market. A weak market will greatly help in achieving a more ambitious price target, but in a strong market, a trader should be happy with a moderate gain. Let's go through a couple of examples. Here's McDonald's. The stock was steadily trending down when it traded into a symmetrical triangle characterized by higher lows and lower highs. Volume was below average the day support was taken out, but then ramped up as the stock continued to fall. The move to the midpoint of the pattern was a pretty good predictor of the move out. Here's Pixelworks. The stock dropped about 40% before trading into a bearish symmetrical triangle. Notice how volume dried up within the pattern. The stock then broke down on average volume and easily took out the most recent low from within the pattern. Then, volume ramped up. The move to the midpoint of the pattern was a little aggressive, establishing a target, but it still gave a good frame of reference to work from. Here's Telecom Argentina. While in a downtrend, it formed a relatively large symmetrical triangle. The lows from within the pattern were easily taken out, and volume surged in the days after the break. That's what we want to see. The move to the midpoint of the pattern nicely identified an approximate target. Let's quickly go through a few more. We find it helpful to look at successful pattern formations to train our eyes. Credence Systems. Textbook symmetrical triangle within a steady downtrend. BDH, the broadband ETF. 2-month pattern within a downtrend. Volume was erratic, but that doesn't take away from the setup. Soapstone Networks. Fat symmetrical triangle after a huge drop. Volume was below average when support was taken out and then surged 2 weeks later. And this is a good example of a situation where a trend line drawn through the low of the pattern, parallel to resistance, offered a good idea as to the rate the stock would fall. That wraps up this tutorial. Again, bearish symmetrical triangles are pauses within downtrends and have a definite bearish bias. Ideally, volume should be average when support is taken out, but then ramp up as the stock continues to fall.